Hello, my name's Bruce Lane from GTI Energy. We have in-situ recovery uranium projects in Wyoming and amongst the neighbourhood of UEC, Cameco, Energy Fuels, UR Energy and the like. We are actively exploring our projects. We have defined resources and our ambition this year is to grow those as fast as we can.
Good to see you, Bruce. Thanks for coming back on. We spoke a few weeks ago about the company and I think you're joining us today. Just talk about the kind of excitement and fervor in the market when it pertains to uranium. Everyone's talking about it. How do you take advantage of it? How are you going to change the way that you're set up, or do you change the way that you're set up? Do you need to be talking more North American story? How are you doing this?
Yeah, hi Matt, good to be back with you. Look, the answer to that question is we are definitely doing things slightly differently to what we did last year. We know that there's two reasons for that. One, we made a lot of progress during last year, which has given us a lot of confidence to invest more heavily going forward in a few particular areas. But also, yes, the conversations are different now. There's much more interest. I think there were some deaf ears around for a good part of last year due to, I guess, the macro environment, the sentiment. And also uranium was still kind of interesting to a lot of people, but I think there was still a fair bit of sitting on the fence for those that weren't already, kind of buried in the story and really, really heavily committed. So we've seen that change. I think, clearly the uranium price and our share price has also responded. So, but we always had a plan to put some more boots on the ground in the US, and we've done that by hiring Matt Hartman as our US President of Operations. And he's a guy with lots of industry experience, ISR projects. He's worked on Dewey Burdock. He's worked on Cameco Smith Ranch Highland. And so, we've got that technical and commercial capability now added to the portfolio that we've got over there with Jim Boffman and the team at BRS. So we are spending more money, putting more effort and emphasis into things. And we'll also be telling our story more broadly through the course of the next few months in particular.
Right, but does a market like this help an exploration company? Because, you're in the early stages. I get the kind of technical competence here, but commercial, surely that's too early.
We all know that the early responders in terms of investment interest and share price are the top of the tree. Cameco, investment grade type opportunities for investors, whether it be SPUT or the ETFs. And so we've seen, kind of heavy participation in those vehicles, relatively speaking, over the last year or two. We've seen it then move down to the developers, the Bannermans of this world. I guess the outlier there a little bit is Peninsula, but the other developers, who've got projects like Boss has done extremely well, another ISR project. So we've seen those guys really catch fire and move hard. And we've always expected that at some point the exploration cohort will get a bit more interest as those investments, the developers mature. And so we've seen that. So from a commercial standpoint for us, it gives us confidence around timing. And I think we've talked before on one of these calls about how important timing is. And, we do have to watch the fact that we got to go and raise money from investors or sell assets or get royalty deals. There's got to be a way to fund the company. And if you shoot all your bullets at a time when the market's not interested, it makes it pretty difficult to fill the tin again. So, that's really important for us and gives us a lot of confidence to keep going and to go harder.
Right. So tell me how, because we're going to see a lot of new entrants. Speaking this week with Guy Kelly just yesterday, Dustin Garrow, they're saying for the more advanced development stories, they want to kind of see the rubber hit the road, right? If you're going to do an FID, get on and do an FID. For exploration companies, there's going to be a lot of new entrants. There's got to be a lot of people with assets which may work, won't work. It doesn't matter. It's all white noise. For a company like you've got to try and stand out. So what's your game plan? How do you differentiate yourself?
Yeah, look, I think we're readily differentiated just by virtue of the fact of being located in Wyoming and in the US, obviously. We know that the US has this really unique problem in the world, being the largest buyer of uranium with a need for about 50 million pounds a year, and really not producing much to speak of at all. They used to produce over 40 million pounds a year back in the 80s, but obviously the industry got decimated by megatons to megawatts, the downblending of weapons out of the Soviet bloc, and also by the withdrawal of US subsidies. And then the Kazakhs appeared and were selling uranium for $20 a pound, or less. And so, the industry really had to stop, had to shut down. So being in the US, where they've got not only a big existing demand, 50 million pounds, but they've also said they want to triple nuclear power to 300 gigawatts from the current 100 gigawatts. So the future looks pretty strong in terms of a uranium requirement. We've got the Russian conflict with Ukraine and the bifurcation of the uranium market. The Chinese and the Russians seem to have their foot on most of the Kazakh production going forward, and Kazakhstan's been a big supplier to the US. So the US really has to find pounds from somewhere else. And yes, they'll get some from from Australia. They'll get some from the likes of Namibia. They'll probably get some from Canada and a few other spots. But it really does put the onus on looking in their own backyard. And we know with this uranium price that projects are economic. Our projects, if they're in production, we know that our neighbours, UR Energy, and Encore and Energy Fuels, they're getting back into business for a reason, and it's not because they like standing in the middle of the desert in the middle of winter. It's because they can make a hell of a lot of money, and so we think that's really captures the opportunity for us. We've got a customer right at their doorstep who's desperate for local demand. We've got pounds in the ground that have a genuine prospect of being profitable at the current prices, certainly, and even at lower prices. So we are an explorer. We're not a developer, and so we can deliver upside through the delineation of further pounds. And as the price of uranium goes up, we think we're quite well leveraged to that occurrence.
Okay, so tell me this: you're an Aussie company with a US asset. Do the Aussies care that your project's in the US? Do the US investors care that you're an Aussie company? How do you play that kind of geopolitical divide?
Yeah, look, the answer to that is yes and no. So, look, the Aussie investors care that we're in the US because they buy the story. They understand the opportunity there, and that's why we're there. So that's easy. They like the US from a geopolitical risk point of view. They understand, that everywhere has its little foibles, but they know we're in Wyoming, and they know they've been producing uranium there using insitu recovery since the 70s and 80s. So from a risk point of view, Wyoming's a self-sanctioned state for uranium. That's all managed. So they care, and they care in a positive way that we're in the US. From an investor point of view, look, US investors, I think we are there on the OTC, so they can buy stock locally. We obviously, the investors from the US to date have been, there's been a little bit of buying there, but a lot of them come to the ASX and they buy on the ASX because they like the liquidity on the ASX if they have, the technical capability to trade. So is it a barrier to them investing? I think if we're there on the ground and we're promoting our story, then I think it's much less of a barrier than it might appear. So certainly that's a focus going forward.
Right. Okay. And one of the other, I think, great conversations we've been having this week with sort of the macro contributors is around the size of some of these US assets. It seems to be someone's got to come in and mop these things up, because individually, in terms of the amount of pounds they're going to be able to contribute into the quite desperate and needy US market, we're talking about £50 million a year. £500,000 here, £500,000. It seems like nothing. I mean, are you relevant?
Yeah, look, I think you've got to remember that at $100 uranium, and look, I think we had a conversation earlier about whether it's north of 100 or the contract price is less than that. But let's use 100 as a round number because the maths are dead easy. A £10 million deposit, that's $1 billion of in-ground value. Now, we know the CapEx from UR Energy's Shirley Basin project, which has been set up as an ISR to deliver resin beads 30 miles away to their Lost Creek plant. Now, the CapEx that they've put forward, there's 33 US, and that's somewhere around the £1 million a year mark, and it's an £8.8 million deposit. So we're clearly in that realm. And if you look at Peninsula and you look at the CapEx that they've put up to do their elution precip drying circuit, That on its own was around 20, and then they had some borefield development added in to their cost scenario going forward. But if you look at those hard capex costs, that would sort of suggest, somewhere in the region of 50 to 70, and then, some borefield development costs on top. So we don't think it's unreasonable to think about being sub $100 million, although, who knows where we'll be in 3 or 4 years' time in terms of inflation. But if you've got £1 billion of in-ground value and a capex around $100 million, well, you don't need to be a rocket scientist to see that can work. And so these are very attractive projects, which was why they're switching them all back on at the moment.
Okay, well, but okay. What I'm trying to do is sort of understand what the risks are to me. So if I look at the way that spot price has moved in the last 2 years, it's tripled, right? Effectively tripled, and that feels like it might be a spike. We've seen cases with other commodities, lithium, rare earths, cobalt, where they've gone shooting up. The world looks great. It's bright, rainbows and unicorns everywhere. Life's going to be different, except it wasn't. Why is uranium any different?
Oh, look, I think and it is well talked about, well documented by some very wise heads in the industry. But I think that this supply-demand gap has been entrenched for a long period of time. It isn't something that's just turned up, and also the supply isn't required to meet a future demand like it is with batteries. It's required to meet today's demand. So we're, notionally 40-50 million pounds short of being able to supply existing demand. And remembering that is the entire requirement for the US. There was a lot of mobile above ground inventory in the past. We think it's pretty clear that most of that, if not all of it, is really now spoken for. It's either found a home in spot, it's been consumed by the industry, it's ended up in China, for instance, which has been building a lot of reactors and has accumulated a lot of inventory because they've got a massive program going forward. So I think the Japanese, they've gone from selling their inventory to now wanting to buy more pounds, and they're struggling to restock. Diablo Canyon, one example, when we were going to have another reactor or two in the States that had destocked their inventory and they've got to restock it. So just based on the current reactor fleet, there's obviously a big gap between what's being produced on an annual basis and what's being required. Then we've got the build on top, and you might have 30 million pounds. I know Guy used the number 30 million pounds for the committed reactor builds, and that's in what you call the near term in the nuclear industry. So look, I don't think this is a fly-by-night thing. I mean, we've been at this for a long time, relatively. We've been working in the uranium space in the US since, really personally since 2018. It isn't something that we thought, we'll just do this in case it has a little flash for 5 minutes. We could see that there was a structural issue in the market with supply and demand, and we're seeing it. It's taken a bit longer than I thought it would to play out, but when it has played out, it's been more dramatic than we thought it would be. So we don't think it's fly-by-night at all. We think it's quite it's a long-term thing, unless you believe nuclear power is going to stop tomorrow, and I don't think that's going to happen.
Okay, so what are the risks to me in terms of the amount of kind of explorers out there? I need to understand what their plan is. I need them to articulate it clearly to me. So your plan is you're US focused. That's the differentiator. Is that it?
Oh, look, we're US focused, but we're also in situ recovery focused. So from a cost point of view and an environmental impact point of view, we think that's really positive. We think our exploration costs and our exploration risk is manageable because we're drilling shallower holes, and they're not expensive holes to drill because they're mud rotary. So we think that from an exploration standpoint, we've got a fairly tight handle on what our discovery costs are. Nothing's absolute. And we had a real win with our Low Herma project because we were able to put pounds on the books without putting a drill hole in. So our discovery cost was particularly low there. But on the drilling that we're doing, we've got a pretty good idea of how many pounds we'll be able to get out of the ground for how many dollars. And that's the exploration skill. We're not wildcatting here. We're not, doing wildcat holes. We're doing expansion holes, resource expansion holes, and sort of getting into the development hole stage. So from a risk point of view, though, generally, you've obviously got exploration risk, and you've got exploration cost risk as well. Drilling this year is certainly more expensive than it was the year before, and it's more expensive than the year before that. I think we started off in the Great Divide, around $9 a foot in the middle of winter. That was it costs more than that now. So, and that's a factor of a bit more demand in the industry, fuel prices, and general inflation in the US. So those things are all part of the risk. Permitting risk, getting on the ground. It's no easy thing, even in the US. I mean, it's easy relatively, but you've still got to get your ducks in a row. You've got to deal with the flora and fauna and the archaeological risk. Thankfully, we don't have geopolitical risk really where we are. It's never eliminated completely, but comparatively, it's low. So those are really the risks. I think the other risk is that there's exploration conducted and it doesn't deliver, the anticipated outcome. I think if you're in the Athabasca and you stick a hole in and you don't hit the juice, it's a fairly painful experience. Where we are, it's less like that. Those big duster holes aren't really something we worry about, because every hole does genuinely tell us where we are on the oxidation and reduction boundary, and it helps us to pinpoint the juicy bit. So, but we do obviously bear some risk if we don't know what we're doing with putting our holes in the right place.
Okay, and what's your view on? You've been in the game a while. What's your view between these sort of low grade ISR projects and these higher grade Athabasca Basin projects? Surely the Athabasca Basin projects are more likely to make more money.
Yeah, look, it's as with all mining projects, and if you've been across different commodities and different styles of mineralization, you quickly realise that it's always a bit of a Rubik's cube, a multiplicity of factors that all have a significant influence on the outcome. And you can have all the grade in the world, but if it's really narrow veined and deep, it's hard to make money out of it. There's calcrete deposits around, uranium calcrete deposits around that just basically need to be scraped off the surface of the earth, and they're only a few feet deep. Now, cost you nothing to drill them, cost you bugger all to mine them, and then as long as the metallurgy is not too crazy, you can make really good money with a bit of beneficiation on those projects. So, ISR's not dissimilar. I mean, it's you can have great grade, but if it's say down below the sort of 200 meter level, the costs go up quite significantly. So where you want to be, like where we are, where the mineralization to date is around the sort of 400 or 500 foot mark on average. It's not exactly that, but it's on average. Some of it's shallower, some of it's slightly deeper. As long as we're below the water table and we've got good thicknesses in the sand, so that we get the permeability for the slow kinetic leach of the lixiviant, then our costs can be quite modest and quite well managed. If we have to do an acid leach and we're at twice the depth, then both those factors are going to really influence the economics. So no two deposits are the same. Some of them are pretty similar, which is helpful, and that's what we found in the Great Divide. Our project's very similar to our neighbours, and that gives us great confidence that what we're seeing in our drill holes is working for them, or at least something very similar just down the road. And in Cameco's case, 10 miles away, and in the Great Divide, it's Lost Creek, and they're about 15 miles away. So we're dealing with the same sort of geology, same sort of thicknesses and depths as some of those deposits. Then that will give us great confidence that the economics shouldn't be too crazy.
Okay, and one final thing on just risk is high risk, high leverage exploration versus development, advanced development, or producers. As an investor, I want a balanced portfolio. Again, how do I differentiate between the high risk, high leverage stories there? Because I do want them in the portfolio as part of a balanced portfolio, but it is high risk. It's not a case of high risk, high return guaranteed. It's high risk, binary, 0 or something, right? So how do you pick a good one?
Yeah, look, I think you know, certainly where we are, I believe, is we're not on the really high risk, massively leveraged end. We're not going to get that hole that sends the share price to, up, 100 times or 20 times or anything like that. We're much more mature. We're not at the development end. We don't have a PEA. But if you look 12, 18 months down the track, those are the sorts of conversations that we need to be having with investors, is that, we need to find a way to put enough data, enough information, enough IP around this deposit to be able to then put an economic story around it, however preliminary that might be. So, look, there's obviously, if you really want the higher cost, high risk thing, there are plays around, the Athabasca is the easiest one to point to just because the exploration costs are so high. But there's some really good people there who do know where to put the drill bit, and they seem to have repeatable success. And so, that they're worth a punt. And I've got one or two of those in my portfolio. So, but I also really like this US story. I really like Wyoming simply because of the context and because you've got these players around. And if USC, for instance, is going to turn their mill on at Willow Creek in August, as they say, and Amir is saying he's going to sell it into the spot market, and all power to him because the margins should be quite good. Then those mills need more feed one way or another, and so when we're in that environment where we kind of have some optionality around, maybe it's selling a deposit, maybe it's partnering, but more than likely, you've got to look at a development scenario, and that's certainly where we'll hit. And if the other things come up, then that's great. So, I think where we are in the risk spectrum is not at the really risky end, but hey, we don't have an economic study yet. So, but there's a clear path to where we want to get to and how we get there. And that's our job over the next, 2, 3, 4, 6, 12, 18 months, is to keep people on track with what the progress is going to look like, what we need to do to get from A to B, and then deliver it.
Look, Bruce, I hear what you say, but I'm looking for more. What is it that truly differentiates you from all of those other stories?
Yeah, look, I think that we're one of the things that's quite different about us is that we've got a deposit with defined resource, and we've got a pathway to a much larger resource, both at our Low Huma project and at our Great Divide Basin projects. And then on top of that, we haven't actually put any pounds out for Green Mountain, but we hope to in the future. But to the best of our knowledge, there's no one that is kind of, I'll use the term free range, sort of running free from one of the major companies. We know that Nuclear Fuels is pretty active up the road with KC, but they haven't got a deposit yet. They haven't got a resource there tied up with Encore. We've got one or two around Strathmore doing some stuff, but they haven't really got an ISR deposit of any scale. And that's not to criticise them; it's just where they are in their life cycle. Premier American Uranium would be the same. They're sort of early days in terms of putting pounds on the book. So we think we're the only ones there that have got something that is looking meaningful, and so we think that differentiates us quite substantially from all of the major companies that are around us that are actively in production or about to get back into production.